Hi, John Dobas from Forbes here at the San Francisco Money Show, talking with Mike Larson from Weiss Ratings. He does, it's called, what's the newsletter?
High yield investing.
High yield investing, there you go. So I like dividends. I'm a dividend guy by nature. So what kind of, you have high yield bonds, right?
Well, high yield bond ETFs. We've
high yield
got
bond
a couple
ETFs.
of those that we got.
So the HYG and the JNK?
Well, you know, actually, one of my favorites, it's one you hear of less, it's called ANGL, is the ticker symbol.
Fallen Angels. Sure.
Fallen Angels. These companies that used to be credit quality rated, their bonds have dropped because they've run into earnings trouble or credit trouble and so on. And you know, you still get a nice yield, 5.5%, somewhere in that ballpark. Okay. You're diversified. It's got industries that, again, have fallen on kind of hard times like energy, but that their bonds already reflect that, right? Their yields already reflect the potential damage. And so I think there's some bottom fishing that you can do there, get a nice yield, and you get that consistent dividend earning, you know, the dividend power.
You know, the 10 years of really low interest rates and 36 years of falling interest rates have really helped things that pay dividends or have a high yield component to it. So, you know, how worried are you about interest rate sensitivity? Is that some sort of coming to the thought calculus a little bit?
You know, it's funny. I mean, we've got a Federal Reserve that's clearly started raising interest rates. They've done it 4 times. They're continuing to indicate they want to raise them more. But the funny thing is, the market is absolutely fighting the Fed. Everything that is supposed to go down in price when the Fed raises rates is going up, and everything that's supposed to go up in price when the Fed raises interest rates is going down. It's a weird environment where, and I think there's a number of different reasons for that. I think it's going, you know, interest rates still remain well below normal levels. It's going to take a long time to get to normal levels. The real inflation-adjusted interest rate is still well in negative territory, so it's not at those levels that really start to bite for the economy. And people, again, this sort of demographic drive of people needing income isn't going away.
No, there's big populations here and abroad.
Yeah, I mean, you need that yield. And again, if you're getting 1% from a CD and 2% from a 10-year Treasury, nobody can live off that. And you know, you've got to make that retirement nest egg last. If you're already in retirement, you've got to build one if you're not.
Real estate has done well, so real estate investment trusts. Are those well represented in your portfolio? You
know, we do have one, actually a hotel REIT, it's ticker symbol INN. They're involved in the hotel space specifically because if you look at the different industries, the sort of subcategories of real estate, the leisure business to me, the hotel business has been pretty strong. I think that's leisure spending, overall travel spending has been holding up nicely. You've got a weak dollar, which tends to help in terms of demand from overseas travel to the U.S. So all those factors add in, and that's one that I like in that space. And that's kind of, if I look at everything that's involved in real estate, I think hotels are probably one of them.
Have you heard of Host Hotel Properties, HST?
Yep.
I've got that. I've got Chatham Lodging Trust, CLDT, and Hersha Hospitality, HT. And they have great yields, all these things. A couple weeks ago, there was a downgrade, I think, from Goldman. It hit the whole sector about 4%, 5% down across the board. But now they've come back in the last week or so and made it up. So
you've got REITs that are coming back, and you look at, just this week you had the utilities space. The utilities index just hit a multi-month high. So I think that just shows you that despite this talk of interest rate hikes and the actual hikes we've seen, the companies that should theoretically get hurt are not. And that tells you that, again, it goes back to the level of interest rates, the fact it's going to take a long time to get to a level that's going to bite. You can build up a lot of income in the meantime.
Right. Well, anything else you want to add to your
I think,
burning a hole in your pocket to talk about?
Like I said, I think this is actually an environment where you really do want to kind of fight the Fed. Until we get to that higher level of interest rates, you can continue to stick with your dividend-paying stocks, your dividend-paying ETFs, and I think those sectors are going to outperform.
I hope so.